Welcome, everyone. I am Xavier Smith, and today I'm going to talk about one of my hands down favorite investing strategies, and I think it will be the best strategy in 2025's complex stock market to come. We don't know if this crash is coming, we don't know if this boom's going to keep going. So, what this strategy is it's covered calls. So, you probably always been told that options are super dangerous, super volatile, and you shouldn't invest in them. Well, that's for the people buying them because the people buying them, if their options don't execute, they're just betting. They lose everything. You're the one selling those. So if they lose, you take all that money. So there's really only upside for you. There's a little downside, but it's not much. So these covered calls can make you consistent income and they are pretty low risk depending on the companies you pick. And I will show you what companies, like what good companies look like. So without further ado, let's get into it and let's get you making some money. So, a covered call is this option strategy where basically you own some shares and then you sell a call against it. So, what this is you own 100 shares per call you want to do. So, if you have 100 shares of a company, then you can sell this call option, which is someone basically bidding. They're bidding that this stock is going to be above this price, right? And you're selling that bid. So you're saying, okay, you can buy the stock at this predetermined price called the strike price, but you are going to pay me a premium for that. So if it doesn't end at or above that strike price, you get the premium to yourself. And if it ends above that, clearly you said you are going to sell at that premium. So imagine you own 100 shares of this company, like XYZ, right? You buy at $50 and you sell this call for $55 strike price, right? And you could say they pay you a $2 premium. Okay, so we could say this is a week out because that's very real in this situation. I found multiple that are a week out and they're paying me like 4 6%, right? So imagine this. If it goes down, right, which is your only downside, if it goes down, then like if it goes down to 45, right, which would be a pretty big drop for this company, that'd be like 8, 10%. Yeah, like 10%. Then they paid you $2. So that drop, you're covered another $2 per share. So you'd be covered all the way to 48. So you have to tank less loss, right? And then you can sell another call if it ends below their premium, well, their strike price at the end. So then we could imagine it goes up, but doesn't go to 55. It goes to like 53. So at the end of the week, if it's at 53, that option expires worthless, but you get the $200 they paid you, right? So you made money on the stock and you made that $200 they paid you. Now imagine it shoots up. It goes to like 67, right? It goes way up. Well, the thing here is they paid you that $2 and you make the $5 gap of selling from 50 to 55. So you make $7 a share, 100 shares. So each contract you sell, you make $700. Thing is, you've already said, okay, I'm fine with taking $700. You're like, I put 5,000 in, I will take 700 because that's a good percentage for 1 week. So that's what a call is. You are basically buying 100 shares of a company and then you are selling it, like selling this bid to someone else, and they're saying, okay, I'll buy it at a higher price, but I'm going to pay you for that. Because the thing is, it doesn't take too much risk on them, right? They're not putting that much money on, but the risk is they lose all of it. For you, you are just holding this company, and all they're doing is just paying you to hold it. It goes up, you make money, and you make money off the premium. Goes down, well, you were going to be holding it anyways, and they're paying you a premium, so it like gives you money anyways to make up the difference. So that is why these calls are so powerful because there's very little downside and there is so much upside. I mean, your upside is limited. You can only make a certain amount of money, but the downside isn't really there. So you want to find these companies that you like. You like the price they're at, and you would buy them right now, right? Find a company. You're saying, I would buy this right now. I like this company. Usually I'd say one that's like been around for a while. Right now, Dollar General's a big hit for me. Five Below's a big hit. Right now, these retailers are going down, like Kohl's is down. But things like Target, if Amazon's down at a price, you would want to buy it. Apple, right? These ones, and the more volatile the stock, the more the call option is going to be worth. And the longer this option goes, is the more it will be worth as well. But I like selling these week-long calls, just get in, get out, and I get like 4 to 6%, and I'm super happy because I put 20 grand in and I get like 1,000 back, and I'm like, okay, I'm done. So find these companies that you like the price they're at, you would buy right now, and you wouldn't be sad if it goes down, or you wouldn't be sad if you made a little bit of money. Because if it keeps going down, right, you already made that premium and it just brings your average price down. So technically, you'd be buying it for a lower price than if you just bought it before at the normal price and held, right? So all these long-term people are saying, okay, you're going to buy at this price, and then you're just going to hold forever, right? Until it gets to this price you want. But it's got so much volatility. Stocks are made to go up and down, right? So why not take profit where you can get it and say, okay, I already have 100 shares of this company, like 100 shares of the S&P 500. Why not just sell a call, take some passive income, like sell a call this week. If it doesn't hit, I sell another call, right? And the thing is, if you buy at 50, you sell this $2 call, right? Doesn't hit, your price is now 48. So you're good to 48. But then if it keeps going down, you sell a call at 50, they pay you another $2, your price is now 46, right? So your price keeps moving down each one of these calls you sell, and you're just making profit the whole way. So even if stocks are dropping, you are lowering your price and you are making profit. So that is why this is so powerful. Now, let's get into an example. So I guess we can just look at like 3 stocks that look pretty decent. This is what it looks like using the strategy. I probably started using like here. Then this was a big hit because I found one. This was SMCI, which was a crazy good company. And then it's usually just passive income. So I'm just getting money here. But clearly, you see the day, you're like, oh my gosh, you were up so much, then down. How are you doing that with this strategy? Well, you see, not really doing the strategy right now because I'm waiting for this dividend to roll in and I bought the stock. So this is what happens when you buy the calls. Clearly, I bought a ton of calls and I'm down $450 today. So I'm on the receiving end of this horrible, horrible system. So you want to be the one making money, not the one losing money. Okay, so we can check out a few. We can check out like Macy's, right? Macy's is down. There's probably a reason for it, but it's just saying, okay, if you would want to buy at this point, right? If you'd be okay with buying right here, what we'd check is, okay, first of all, recommend Robinhood. Robinhood is great, fantastic, and it does options super well. So I'd say, okay, trade options, right? December 13th, that is in 4 days because it is the 9th today. So if I said go up, right? If I said go up to $17, they'd be paying me 62 cents. So 62 divided by, and then we say, okay, how much is the stock right now? The stock is 16.74. So 16.74. On every stock, I would be making 3.7%, which times 100, 3.7% at the end of this week premium, right? But what if you think this stock's going down? You're like, shoot, that is nice. And if it did execute, first of all, we can say, okay, that'd be another 26 cents, 0.26 plus 0.62, give us 0.88. So if it did actually execute, divided by 16.74. So if it did execute, they would be paying me 5.3%. Okay, which I'd be totally okay with. But what if you find a stock like this and you say, okay, I want to buy it now, but I'm super scared it's going to go down, right? Well, what you can do here is look for the lower calls, which means you are going to sell this stock for a lower price than you bought it, but this premium will make up for some of it. Sometimes these won't even cover the full amount. Like you will lose money on them. But the idea here is you want to buy right now, but you think it's going to be below 16.5. If you think it's going to be below 16.5 and you just want this premium, because of course the premiums are higher because they have to make up for something. So if you say, okay, I think it's going to be below 16.5 by the end of this week, you'd get, okay, they'll pay me 84 cents, right, divided by current price, which is 16.74. So they are paying me a 5% premium, right? But that's if it's below 16.5, I'll be making 5%. But there's still a loss here. Like if it does sell at 16.5, I have to calculate how much I would lose. Okay, so I lose 26 cents. They pay me 85, but I lose 26 cents per share. Then divide that by market price, which is 16.76. So there I'd only be making 3.5%. But you save yourself by saying, okay, if I really want to get out and it's still above 16.5, I still get 3.5% this week. So that's if you're scared something's going down. Okay, and then you can keep selling down here, but the more you go, like the further you go down, the less actual profit you'll make, and eventually you'll start losing money. Like here, they'd pay you $16.70, which you'd be losing 8 cents per share, so $8 per contract. Okay, now we could check out another one if you want, like Cracker Barrel. All right, people don't like this stock. Personally, I was in it for a little while, but then I can just show you one I was in. And it's kind of, you just got to keep perusing these stocks that are down, because some days they're going to pay you like a 6% return, and some days they're going to pay you a 1% return. And I'll show you that with Dollar General. So here, Cracker Barrel, you're like, okay, I might want to buy it now. You're thinking, I could peak back up, I'd buy it. I don't know why you'd want Cracker Barrel. You might though. This is December 20th. So this is 2 weeks out, or a week and 4 days out. So they'd be paying like 75.80 cents divided by 49.52, I believe the price is. 49.48 divided by 49.48. So they'd be paying you a whopping 1.6% for going up, right? Which would add another, what is that, 52 cents? So that'd be $1.52 now, $1.62. That price is just jumping. $1.62. See, that's, options are so volatile. Like that thing just almost, it went up like 30-40% in price. So now it's 115. So we'll just do divided by 49.50. It'll be a lower than normal. So if it did execute by this 2 week mark, you'd be getting 3.3% in 2 weeks, which is pretty good given that most people don't get that, right? They get 5% a year, like tops, off of their investments that get interest in the bank. So now I'll show you one. Like if you think it's going down, of course you can sell like one of these calls. You're gonna make more, well, make less if it does execute, but if it doesn't execute, you're gonna be making a very nice premium. So then I'll just lastly show you one I was in, just because people are like, why are you in Dollar General? Why are you looking at Macy's? Why are you looking at Cracker Barrel? It's all these companies that are out of favor right now, right? Like clearly their earnings went down because probably like Trump's tariffs probably had something to do with this. But you see, it's down. I'm not saying it's not going to keep going down, right? That I'm not saying that at all. I'm saying in 1 week, I believe it will not be so much lower. So I'm taking the upside here. And on like normal companies, like if you wanted to look at like Ford, all right, Ford is a great one. It's at 10.59 right now, right? Like it's at a normal price. It's at a very normal price. I would be very happy buying right now. Sorry, I'm going on a little tangent here, but like even if you went down, which is probably where you'd make the money, you'd make 10 cents. So 0.10 divided by 10.5, you'd still be making 0.9% in a week, which isn't anything to scoff at, given that you do only make 5% a year off interest, and that is a lot more money than you'd be making off interest. Okay, to get back on the tangent, or a tangent, something that you'd go off on, never mind. I'll just go to Dollar General and show you one of my trades. So, Dollar General, I say, this was just last week. I say, okay, Dollar General's pretty low, right? It was at 79.73, just took a big tank. And I said, okay, I'll buy 100 shares, and then I'm going to sell an $80 call for $470. So that's 47 cents divided by 79.73. So I was just checking these stocks. I was checking upcoming earnings, and I just saw, okay, this one, it just tanked. I'm just going to buy it and hope it doesn't tank for the next couple of days. Boom. That was 0.5%. Oh, it was $4.70 divided by 79.73. So that's because 470 is really $4.70 a share. It's like, who is paying $4.70 a share for that thing to go up 27 cents? That's why these really volatile ones, or like they just had a period of volatility, you can get so much money off of it. But if you're a little more conservative, you'd go like Ford, right? You'd go something that gets a little less than 1% a week, which is still getting you roughly 50% gain a year, which is absolutely wild if everything goes well. And usually on those ones, they do. But on these ones where there's a little more risk involved, you can get a big gain. Like here, they were paying me 5.9% in a week. Let's see what day that was on. I bought that on December 3rd, and the call was for the 6th. They were paying me 3 days. 3 days, they were paying me 5.9%. And first of all, you'd be like, well, does that mean it's super risky to get in? Well, why are the people buying calls like that? Right? My thought is, if people are buying calls, clearly they might know something I don't, or they think this thing's going up. They're taking on all the risk. They're thinking that for them to break even, they'd have to get to 84.70 for them to break even on this call if it executes, right? That's in 3 days. So I'm not taking the risk. They're taking the risk. And that 470, like 79.73 minus the $4.70 they paid me per share, brought my price down to 75.03. So I was covered if it dropped a little bit. So if it dropped that 6%, I was covered. I did that again, and I got another like 6%, and I came out of there doing pretty well. So these covered calls are so powerful because they're making you passive income every week on stocks you already want to own. So these less volatile ones in these bigger companies usually have like smaller returns, maybe 1%, a little less than 1% per week though, where you're still making free money. These more volatile ones, the ones that just dropped but are still big companies, you want to find the ones that just dropped and you're saying, I want to be in this company right now. I want to buy into it and I will stay in it. Like I would have bought into this, and if it goes down, I'll buy more, right? Well, what you're saying is, okay, they are going to give me a higher return, but I take the risk that it drops again. What this call does is it kind of brings down your average price a little bit. So what these calls are doing are a lot of times they're giving you like 4% a week, these more risky ones, but they're also meaning the stock can drop another 4% and you're still breaking even. So it's really important. So if you do like more stable stocks, right, you can get like 1% a week, probably pretty easily to the 50-second power, because you're doing that every week. If you reinvest that money and do it again, you're getting 67.8% per year, right? If you get 2%, which means most things go right, and you're doing a little more risky ones, but still pretty safe, right? You can get 180% a year. Again, there are going to be like setbacks, right? You're going to invest in individual stocks sometimes thinking it's going to go up and it's going to drop. I do that same thing. Sometimes I buy the calls and it goes super wrong, right? But what I found is a lot of these companies I'm buying into, when they're really low, it might have been the bull market, but next year in 2025 is going to be even more crazy. A lot of times they go right back to where they were. And it says I lost a ton of money on the call, but I gained a ton of money on the stock. But really, that difference is the money I already agreed to make, which is like on those ones, usually like 6%. So if I could find one that was 6% a week and every single one of them worked out, I would be coming back with a 1,970% return per year, which not everything's going to work out, right? What I could maybe try to expect is a 3%. If I went strictly this strategy, I didn't do individual stocks, I would get a 365% return. So I haven't tested this in a bear market yet, but there's always someone buying a call. There's always someone betting on a stock to go up. So if you just take the other side of the bet, you take that guaranteed money, right? Then why not? If you're already going to be owning the stock, then why not sell it and take a quick little paycheck? So this is the strategy I think will transform all of your portfolios. You'll be making money. Your account will look like a little like step, right? At the end of every day, you're not going to be down money unless something went horribly wrong. Like a stock dropped like 8%, right? But even if that stock drops, you gain money on the call, but you can only gain so much money on the call because they only put so much in. So you can only gain to that max. But like your account will soon look like a stair step, right? And occasionally you'll find a big one and go, and it'll be crazy. Sometimes you'll have little drops, but mostly every day you will not lose money. You're gaining money, which is important to a lot of people in their retirement, right? They don't want to lose money. They just want to have good gains. Well, if you're making 1% a week off Ford, right? No one's going to complain about that. Even if someone's like, what if Ford goes back down to 950? Well, every week you're making 1%. That means your average cost is moving down by 1% every week, which soon your average cost is going to be at 950 anyways. until one of these calls executes and you're like, I still want to be in the stock at this price. You buy it again, sell another call higher, and you're just making money, right? You're making that money, and like no one's going to bother you. They're just like, okay, take the money, right? There's always going to be people betting on the stocks because the people betting have the opportunity to make like a 300% gain if the thing shoots up, right? But if it shoots up, you make the money. You limit how much money you can make, but you guarantee yourself that profit. And if it shoots up, you're just saying, okay, I guaranteed myself this profit. You could just take it early, right? Not even let the thing execute. So thank you so much for watching. I hope this video was helpful. And honestly, I think this is going to make so many people so much money. It makes me money. And even if you have like $1,000, you could still get 20 bucks a week, at least with these like $10 ones. Like Ford, you could get like 16, 19 bucks a week, which is like an hour of work, hour and a half of work, minimum wage. So it's saving you money and you really don't have to spend much time on it. You just have to find maybe Sunday, maybe Monday. You just say, okay, I'm going to find one stock. And in the future, I'm probably going to have a system where you pay like 15, 20 bucks a month. And I'm going to give you all these options. It's like, if you have $1,000, this is the stock I'd get into. It might just be a dividend stock. They just pay you a dividend that week, like Kohl's, which I'm in right now. They're paying me a $1,500 dividend. I'm like, okay, like 3.5%. And then like $5,000, you can get into this stock, 10 grand, get into this stock. And then I'll put the yields with it. And maybe I'll say like, okay, it actually did do this much to make a track history. But really, if you don't want to pay for that, which it would get you a ton of gains anyways, if I did it weekly. If you didn't want to pay for that, just try to find one stock you want to get into, or you're already in that you have 100 shares of, and just try selling a call. Just sell one. And if you say, I really think this thing is going to go up, but like I want that passive income, you can buy 150 shares, sell a call on 100, and then keep that 50. And if it goes down, you lose all the money on the 50, but you like gain money on that 100. Like if it goes down, your 100 moves down with it because that premium. Okay, yeah, once again, thank you so much for watching. I hope this video was helpful, and I really hope a prosperous future for you all. Please subscribe if you made it all the way to the end. I appreciate it, and it really tells me that I should keep going, keep telling you how to make money. And yeah, thank you so much, and I hope to see you again soon. Bye.